Joining us right now is Tom Quaadman. He is the Executive Vice President for Capital Markets Competitiveness at the U.S. Chamber of Commerce. In February, the U.S. Chamber joined that lawsuit on Exxon Mobil's behalf against two activist groups. And Tom, thank you for being here. Let's dig through this a little deeper. For any viewers who weren't with us a half an hour ago, maybe we need to back up and explain what this battle is over. Exxon Mobil is suing two activist shareholders that I believe for the third year in a row brought proxy requests that they wanted to put to the shareholders that Exxon thinks are out of line with what it should be considering and counter to the company's best interest. Why don't you talk a little bit about why the Chamber of Commerce decided to get involved in this?
Sure, Becky, good morning, and thank you for setting that up. Let me make 2 points at the very outset. Number one, with CalPERS, let's remember CalPERS more often than not has failed to meet its discounted rate, creating unfunded liabilities totaling tens of billions of dollars that taxpayers then have to make up and have led to, have been a factor in municipal bankruptcies in California. So taxpayers and pensioners in California should be questioning CalPERS as to why they're attacking a high-performing, very profitable company. Number two, the reason why we're in this mess today is because the SEC has abdicated its responsibilities. Our shareholder proposal process is at best an Alice in Wonderland maze of special interest activists. At worst, it's broken. The SEC has neutered resubmission thresholds. They've repealed the proxy advisory firm reforms. They have just opened the door to any proposals that have broad societal impact. So while we have 90% of shareholders repeatedly rejecting this proposal, yet it is here again. So, unfortunately, Exxon had no alternative but to go to court since the SEC no longer want to be an irrational arbiter here.
This is the changes that the SEC made. What was it, a year and a half ago or so when those changes went
A couple
through?
of years ago, Staff Legal Bulletin 14L, where they said broad societal impact issues are allowed regardless of what is going on in a company. What most people fail to remember with that is what is a broad societal impact in a Democratic administration is one thing, in a Republican administration, it's another. And what that means is that, both businesses and investors are caught in the middle of that pendulum swing.
So meaning you want businesses to be taken out of politics entirely, that you don't want to be dealing with this, which is kind of similar to what we just heard from Harvard University, that they don't want anybody there making official statements on things that are not relevant to the absolute mission of the college or the university at this point.
So, well, we're talking apples and oranges, but when you're talking about a public company, right, the shareholder proposal process and director elections are geared towards stewardship, long-term growth, return, et cetera, issues like that and strategies. But instead, what we've seen over the years is that, the shareholder proposal process is now dominated by political and social issues that we know politically, right, are very divisive in our election season, but we're throwing them into the boardroom, into the shareholder meetings where they don't belong. And it takes the eye off the ball of what investors and both management and directors are working towards. So the system itself is broken. And that's why Exxon had no alternative but to go into court. It's not about limiting shareholder rights at all. It's to ensure that those processes work in the manner that they're intended for, and not to make the boardroom a political debating society.
So where do things stand with that lawsuit at this point? And what do you hope to take away from it?
Well, look, I think one, we've seen Judge Pittman has ruled that that this is not moot. Two, I believe one of the activist investors has gone back to Exxon just in the last day or so, saying that they won't move forward with this again. But I think, look, there are two things that are, I think we have to really put in context here. One is the proposals were rejected by 90% of shareholders. There comes a certain point in time where, that should not, come back. Number two, that proposal is actually designed to put Exxon out of business. So again, we've seen where companies are deciding they no longer want to go public because they don't want to deal with these issues, or we have to change these processes to make sure that they're working as intended.
What does the proposal say exactly, the one that the activists withdrew after Exxon decided to sue them?
It was about Scope 3 disclosures. They wanted Exxon to make Scope 3 disclosures, which even the SEC in its climate disclosure that was finalized a few months ago was restricted or taken out altogether. And part of it was because farmers in states that have Senate Democrats in them, petitioned the SEC to do away with that. So Scope 3 is not a measure of what actual emissions are. And it was just designed to put a company out of business, which actually raises a fiduciary duty, which I know was raised earlier this morning. But, can an investor just, purchase $2,000 worth of shares and try and foist a strategy to put a business out of business? It doesn't make any logical sense, particularly for the 90% of investors who have rejected that.
Yeah, I can agree with the prospect that you shouldn't be able to come in and buy a few shares and then suddenly wrest control of the agenda and take the focus on that and require management to come up with a large portion of their time that they're dealing with it. But what is the threshold? If it's not $2,000, I mean, CalPERS said they have $1 billion. That's less than 0.2% because Exxon right now has a market cap of more than $515 billion. What is the threshold?
Yeah, well, look, we submitted a rulemaking petition on this years ago. And in fact, in doing that, we also want to make sure that individuals did have an ability to do that. Unfortunately, we see 6 individuals who file majority of shareholder proposals, which we call the gadflies in the Fortune 250. Jay Clayton, when he was SEC chair, actually put in place some very thoughtful proposals regarding thresholds for when stockholders can issue a shareholder proposal, when something that has been rejected repeatedly gets a timeout for a little while. And unfortunately, the Gensler SEC has just neutered that. So they've left in place those thresholds, which go back to 1955. So that's something I think we need to come back to. And additionally, the proxy advisory firm reforms, right, were under Jay Clayton again, were designed to ensure that recommendations were done in an open process, not a black box that activist investors could steer the advisory firms, but also base things on things like economics and return. And unfortunately, that has been done away with, and we're in court with the SEC on that issue now.
I can remember when Evelyn Y. Davis was a director's biggest issue and concern.
With her famous newsletter.
Yeah, exactly.